Isaac with Rosas Homes, powered by Guide Real Estate, and today I'm sitting here with...
My name is Nima and I with, I'm not with Guide Real Estate. I'm with Big Valley Mortgage.
It's been a long week. But today we're going to talk about what you need to buy a home. Alright, so first off in this video, we're going to dive into what you need as far as the loan aspect of it all. And then towards the end, we'll dive into a little bit of the escrow process and what it looks like after you're pre-approved and where I take over as the real estate agent. So let's just jump right into it. So this is gonna be a real fundamental video just for those who want to get an idea and a little more of a grasp on what a loan really is, and for those who just have no idea. So Nima, what is a loan?
Well, Isaac, a loan is I give you money, you pay me back with interest.
Okay, pretty simple.
Right. I think it was a great video, guys, and we'll talk soon.
Okay, so it's a pretty simple concept, but I know it gets a little complicated when you dive into each type of loan, right? So would you mind diving into each type of loan and what the differences are between them, conventional loan?
I get that question asked all the time, Isaac. So let's go ahead and set things straight today. So the main differences between conventional and FHA are the requirements that come with the loan. So for example, typically with an FHA loan, they require a lower credit score, typically 580 or above, versus conventional, they see 600 to 620 and above, depending on different programs and guidelines. Another main difference is an FHA loan requires 3.5% down on a home loan, which is a conventional loan you can do anywhere as low as 3% to up to like 20, even more sometimes. Another huge difference is mortgage insurance, and not to be confused with homeowners insurance. Mortgage insurance is an insurance policy that the borrower or buyer pays for on a monthly basis in the event that if the borrower becomes foreclosed on their home, then the lender will be insured and covered. Now, the mortgage insurance on an FHA loan is backed by the federal government, versus the mortgage insurance on a conventional loan is typically backed by an investor. So those are the main differences between the conventional loans and an FHA loan.
Okay, awesome. Thanks for clearing that up. And I got another quick question I'll throw for you.
Yeah,
one liner. There's always that rumor floating around that FHA loans are only for first-time home buyers and for first-time home buyer programs. Is that true?
Not at all. First-time home buyers can also, they can even qualify for a conventional loan. It all depends on each individual borrower. Each borrower has a different credit score, income. So a good loan officer should be able to look at each individual borrower, break down their financial history, their credit score, and be able to put them at the right loan program for them. Not everything is cookie cutter for a certain group of people. Each individual is set for a different type of loan.
Right. Okay, awesome. And that kind of leads us into our next question that I always hear is what is an interest rate and how does it affect how much I pay per month, right? So first of all, could we dive into what an interest rate really is and how to pay that?
So interest rate is actually the cost of borrowing money. I mean, obviously money ain't free. So when a lender borrows money, gives money to a borrower, that borrower is obviously required to make a payment for the money they receive to make a purchase. Now, they also have to pay an amount which is agreed based upon a percentage per month, and that's pretty much how the lending business has come around.
Makes sense. That makes sense.
Mm-hmm.
So as far as interest rate, is that included in what you pay per month for your mortgage? How do people get that? Is that something they pay with their property taxes at the end of the year, or is it all kind of jumped into one monthly payment?
So it all varies, right? So when you first start your loan, the first thing you want to calculate is the principal, which is the balance that you have on your home loan, and and on top of that, your interest. They calculate the two based off what's called an amortization schedule. So typically in the beginning of the loan, you pay the interest, the amount that's costing you to have this loan, like a larger amount of interest, and then a small amount of principal. And over time, you'll see the payment schedule change. We're paying more interest, and and less interest and more principal. On top of that, right, on your actual payment, you have your homeowner's insurance, your property taxes, and if you put less than 20% down, you have your mortgage insurance as well. 5 different factors inside of one payment. Now, how that is all calculated, it all depends on the individual borrower. So, for example, if a borrower prefers to pay their taxes and insurance and their homeowner's insurance separately, they have to, they do so at time of escrow, and they'll have to make their payments according to. So, for 6 months, you can make your payment towards principal and interest. However, you're going to have to pay your, every 6 months, be prepared for a tax bill and an insurance bill.
Right. Yeah, and what I've noticed is most people, there is the option to just have that included and set aside each month when you pay your mortgage, and as opposed to having to have a scatterbrain and remember, in 6 months it's time for taxes, whereas some people will have an account set aside every month that
just get it done out of the way,
without thinking about it. So thanks for clearing that up.
Absolutely.
So another question I get asked is, how long does the loan last? Are we, does it depend on if you're well qualified? Are you limited to a 30-year or a 15-year loan? Or how long does the loan last?
Well, it all depends. I mean, typically the average loan, is written for 30 years, but so if some people qualify and they're comfortable making a higher payment, they'll sometimes go for 15, sometimes 10. But, ironically, did you know that actually the average loan only lasts about approximately 7 to 10 years?
Oh, no way.
Yeah, because, people sell their homes.
Yeah.
So.
Yeah, it makes sense. Is there any advantages because when you're getting pre-approved, you have the option to do certain loan timelines, right? You can either do 15-year, 30-year, I think you can do 10 years sometimes, right?
Sometimes, yeah. But it all depends on qualifying, right? So if you qualify to make that higher payment per month, just depending on your income and loan amount, any current debts you have, you may have that option if you're comfortable doing it.
Right.
And if you do, then there's certain advantages, such as typically lower interest rate. You pay less interest over time, of course, and you get the benefit of knowing that you get to pay off a loan in 10 to 15 years.
Right. Awesome. Cool. So what happens to the loan once? Let's say you're coming to the end that you've owned the home for 30 years, you went through the motions, and you're coming to the end, or maybe you're halfway through the loan and you still have another 15 years you owe on it, and you're ready to move on to the next house. What happens to the loan if you want to sell the home?
Well, you still have to pay the loan back. I mean, you did borrow money, you gotta have to pay it back.
Right.
So here's a great example. Let's say you bought a home. And let's say you got your current balance on the mortgage is $300,000. You sell your home for $500,000, right? So you have about $200,000 in equity, we're gonna call it, right? So now what that means is you're gonna have to pay $300,000 back to the lender, but you're still gonna have $200,000 in your pocket after everything's all said and done.
Right, because the laws of appreciation in real estate are obviously fruitful.
Oh yeah.
So, is there any penalties, prepayment penalties that a borrower will face if they decide to sell early?
Typically no, but double check with your current guidelines of your loan. But typically speaking, no, there are no prepayment penalties.
Awesome. All right. So let's jump into. See, a lot of people are like, well, that's awesome. That's great hearing about the loan part. Well, I just want to get in the door. A lot of people are like, well, we just want to figure out if we can even get one. So, how do people qualify for a loan?
Well, to qualify, first off, you want to speak to a mortgage loan officer. I just happen to actually know a guy. So you want to contact a loan officer. Definitely can give me a call. And what I do is we sit and talk. We talk about, you need to talk about your income. That's very important to know, because you got to figure out how you're going to make your payments, right?
Right.
Another thing we have to talk about is your credit. So we're going to have to talk about, what is your credit score? Are you known for, making your payments on time and, keeping your finances in order? Or, do you have multiple missed payments and you have some, you have a repossession, or, you just have bad credit. We need to figure these things out. And it doesn't mean it's not the end of the world. We can still work. We can still work on ways to improve your credit score before we get you pre-approved. And another thing we have to talk about too is your current assets. So, you know, do you have funds to put towards a down payment and closing costs on a home? If you don't, we do have down payment assistance options we can work with to get you started and getting you into your home.
Right. So as far as the minimum requirements for someone who just needs some numbers and some credit score number, you know, just something that they could, you know, some information they could gather and do their own homework with. What are the minimum requirements, whether it's credit score, income, and amount saved for each loan type, if you could dive into that?
Yeah, so for example, FHA, you need a, 580 score or higher. And they need about 3.5% down. And there's also down payment assistance options if needed. For conventional, typically you want like 600 credit score or higher, and you also want to have at least 3% down if it's your first time buying a home. And if you're able to put 20% down, then great. So you don't have to pay mortgage insurance. We just talked about what mortgage insurance is.
Right.
So that's going to be the main. That's going to be the two different requirements to get you get you started. But also, you need to be at your same job industry, not the same job industry for 2 years or more, and you also have to show proof of funds, that you use for the down payment.
Right.
So.
And we haven't touched too much about VA loans, but for VA loans, they don't require any down payment. You will have to pay certain closing costs. Obviously, you can't just get a house for no money at all. So, but that is a huge advantage for those who do want to shop VA. So
the VA is a very powerful loan, especially and it's geared towards our service members who have sacrificed a lot for our country. Yeah. And so I think this program works amazing. Like as you said, 0% down. There is of course an additional closing cost that they have to pay. Right. But the good thing is about the VA loan, they have the most competitive interest rates.
Right.
And of course they're also backed and insured by the federal government. And get this, mortgage insurance.
Oh wow, I didn't know that.
Yeah.
That's huge. So what happens, what's the difference? We'll move into our next one. I hope that helps you guys. We're just trying to get an idea of what the bare minimum to get your foot in the door is. So let's move into, you're gonna start hearing these terms once you start your home buying process. Pre-qualified and pre-approved. You're gonna hear those two words a lot. And they sound like they're the same thing, but there is a huge difference between the two. You gotta be weary of which one you're using. And so let's dive into what the difference really is. What's the difference between pre-qualified and pre-approved?
Well, I'll give you an example, Isaac. So let's say, for example, you come to me for a loan, and you say, hey Nima, I make $100,000 a year. I have an 820 credit score. I also have, $300,000 in bank account. And, I never miss a payment, and I can definitely want to buy a house for about, let's say, $600,000, right? You can get me pre-approved, right? Well, no, I can get you that's a pre-qualification based on the information you give me on the application.
Right.
But let's go ahead and dive deeper into your financial history and your credit. Right. So really, once we really run your credit, take a look, see where we're at. See your credit scores, let's say around 720. You really make about $80,000 a year, and there was a typo in your application. You don't have $300,000 in your bank account. You have $30,000 in your bank account. Right. Yeah. But after putting all that information in, and I submit this over to an automated underwriting system, and this automated underwriting system is what most lenders use to determine if they are eligible for this loan type. Right. And let's say it comes back saying that you are approved. Great. You're pre-approved.
Got it.
Right? You're not approved until it actually goes to a manual underwriter, and there is a property with an appraisal attached. Big difference.
Right. So, in a nutshell, one of the biggest differences, one's verbal and kind of just going off of whatever information you said to the lender.
And the other one is full detail. I look down to the nitty gritty, and I can say with confidence that once we go into like an escrow and we send it to an underwriter, come back approved.
Got it. Huge difference. So what happens once, let's say someone has gotten to the point that they are pre-approved and they submitted all their documents, proof of income, they showed you your proof of funds, and they're pre-approved. What happens next?
Simple. We call this guy.
He's right. So that's when I jump in, and that's actually kind of when the fun part starts, at least for a little bit, until obviously there's up and downs once you're pre-approved, but you start shopping for houses afterwards. So that's when I sit down with you, whoever the buyer may be, and we dive into what you're looking for in your house, what areas you're looking for specifically, and any other key details you're looking for in your next home. And obviously, I'm there each step of the way, and he will be as well. Even though he did ran all the numbers for you, he's still going to be a great resource for you, whether you're pre-approved or not. So that's when the home shopping process begins, and I'll be there every step of the way, guiding you through our escrow, whichever home you may end up submitting an offer on, how to submit an offer, key details in your offer that you want to look out for, especially in the competitive market right now. This will probably go out sometime, this next week. It's early 2022. Crazy market right now. So that's when I'm here, get you an offer accepted. There's homes that are getting tons and tons of offers, and that's what I'm here for, is to get you one that's accepted. So I'll be there each step of the way, making sure we get you into the right home.
And with rates increasing, now's a good time to talk to a lender and consult with them. Your concerns about the rise of rates going up, and what's the best way we can do to address that. The best way, really, honestly, is to speak to lender ASAP, and let's get you locked in when it's time to go into escrow. So the sooner that you take advantage of locking in your interest rate and finding your home, the better off you will be than waiting later on when rates do continue to go up. And there's not a lot of inventory in today's market, is there?
No, there's not. And you know what? Then the question is, well, rates are going up. People are still submitting crazy offers. Is the market going to, the market's going to crash? People hold their breath, and then it ends up being for years.
Yeah, it still hasn't crashed yet.
Yeah, it still hasn't crashed, and I don't want to, make any promises. I don't have a crystal ball. I can't see the future, but rates have gone up already. They've gone up about 1%. Is that right?
Yeah, actually. Oh my goch, yes, they have.
They've gone up about 1%.
Yeah, they got up for about 4% right now, and I don't see any going back down anytime soon. If anything, I'm starting to see the opposite. I'm starting to see rates continuing to go up to address the issue of inflation.
Right.
Of course, what's going on in Eastern Europe, and not to mention recovering from the pandemic.
Right.
So we're starting to see rates going to pre-pandemic levels.
Right. Which is normal levels. We're at historic lows, so that's not something to be comfortable with anyway. So if anything, we're just slowly going back to a normal market, right? And the reason I brought that up is because people are worried of a crash, and if rates have already gone up 1% and demand is still high for homes, it's kind of a telltale sign that people are still looking for homes, whether the rates are high or not. So we'll get into one now.
Seriously.
I've been hearing rumors that they're going to go up even higher before the end of this year, so might as well get in now.
Yeah.
Well, my name's Isaac. I'm here with Guide Real Estate, part of the Rosas Homes group. I'm CEO of Rosas Homes, and if you have any questions, obviously this is just to get you a little more educated on the process, but me and Nima, my business partner, we actually sit down, go over all the details if you are looking for a home. But we have our first-time homebuyer consultations, regular homebuyer consultations, where we sit down, dive deep into what exactly you want, whether you can do that or not, and we get you on the right route. Whether it's now or a year from now or 10 years from now, we kind of just sit down with you, get you educated on the process. So I'll leave our information below here, and if you want, reach out to us. We'll be happy to help.